Roth IRA or traditional IRA? Which makes the most sense for you? Is one better than the other? In this video, I'll go over what a traditional IRA and Roth IRA are and how they differ. And finally, I'll run you through several examples to show you which type of IRA wins out in the end. Well, wins out in most cases. And before we dig in, smash that subscribe button. Your wallet will thank you. Let's start out by defining what is an IRA. IRA stands for Individual Retirement Account. These accounts are tax advantage savings accounts designed to help you save and invest for retirement. IRAs are established by individuals, and contributions may be tax deductible depending on factors such as income, filing status, and other retirement plan participation. First up, let's talk about the tax advantages related to these accounts. For a traditional IRA, in most cases, contributions made are tax deductible in the year they are made, and earnings within the account grow tax deferred until withdrawal. For a Roth IRA, contributions are made with after-tax dollars, but unlike a traditional IRA, there's no immediate tax benefit tied to these contributions. However, qualified withdrawals, including investment earnings, are tax-free. All IRAs have contribution limits, and for 2024, the limit is $7,000, which is up from $6,500 in 2023. There's also the option to contribute an additional $1,000 if you are 50 or older, for a total of $8,000 tied to the catch-up benefit. I just hit 50, so I'll definitely be taking advantage of this. Yay me. With a traditional IRA, there could be some limitations to how much, if any, of your contributions can be deducted off your taxable amount based on you or your spouse having a retirement plan at work. If that's not the case, then you'll be able to deduct the full amount of your IRA contributions up to the limit for the year, which is $7,000, or $8,000 if you're old like me. Here's two tables showing you the traditional IRA deduction limits if you or your spouse have a retirement account with work. Feel free to pause the video here to take a longer look. For a Roth IRA, the amount you can contribute, if any at all, is determined by your income and your filing status. The number used to determine your income for this is your MAGI, or Modified Adjusted Gross Income. Simply put, your MAGI is your adjusted gross income with some of your deductions added back in. There's a link here to a site that breaks down how to calculate that. I'll also include the link in the description of this video so you can take a look at it there as well. At a high level, if you're filing single and you make $146,000 or less, then you can contribute the full amount. If you're married, filing jointly, and make $230,000 or less, you also can contribute the full amount. Remember, that's $7,000 for anyone under 50 and $8,000 for someone like me. If you're married and filing separately, you pretty much don't have the ability to make Roth IRA contributions. Here's a table that breaks down the income and filing thresholds and what you can contribute to a Roth IRA to see where you land. Once again, feel free to pause the video to take a longer look at this. Now on to withdrawal rules for each IRA. For a traditional IRA, withdrawals are generally subject to income tax, and there's a 10% penalty for early withdrawals before the age of 59 and a half, but there are some exceptions. Here are some of the common exceptions that can avoid the 10% penalty for an early withdrawal. A first-time home purchase up to $10,000, a birth or adoption expense up to $5,000, a qualified education expense, a death, disability, or terminal illness, and for health insurance expenses if you're unemployed. You'll still have to pay tax on the money withdrawn based on the tax bracket you're currently in, but keep in mind that taking a withdrawal, especially if it's a large amount, could push you up into a higher tax bracket, which may lead to you owing more income taxes than you expected. For instance, let's say you're a single filer and make $45,000 per year and take a $10,000 withdrawal out of your traditional IRA to help with the purchase of your first home, which is so exciting. But you might not be excited when you go to do your taxes the following year. In this example, your income would go up to $55,000 and would move you from the 12% tax bracket to the 22% tax bracket. Now, to be clear, that doesn't mean that that will be the case for all withdrawals, but definitely something to keep an eye out for if you do take an early withdrawal out of your IRA. It could be a double whammy, a 10% penalty and more taxes than you expected to pay. For a Roth IRA, contributions can be withdrawn at any time without penalty since those contributions came from after-tax money. But if you're withdrawing investment earnings, it can get a little complicated on what would not get penalized in tax. Here's a good screenshot breaking down those different scenarios and events. Once again, pause and take a longer look if needed. Now on to the topic of RMDs, or better known as required minimum distributions. For traditional IRAs, when you turn 73, you have to start taking a minimum distribution each year. What that amount is and how to calculate it probably could be a video in of itself. But the short of it is there's a formula based on the balance of your IRA and your A's that determines the minimum you need to withdraw each year after 73. I'll include a link to an RMD calculator in the description if you're interested in taking a look at that. There are no RMDs required for the owner of a Roth IRA or their spouse if left to them, but other beneficiaries have to take RMDs if a Roth IRA is left to them. I also want to point out that your spouse can have their own IRA account as well. Remember, the I in IRA stands for individual. So IRA accounts are not jointly owned accounts. Okay, now finally on the part that I enjoy the most, numbers. I'll go through several examples to show you different scenarios of age, filing status, and income to see for each of those scenarios which IRA makes the most sense. Here's a hint. A certain IRA wins each time. For our first example, we're going with a young, single 25-year-old who makes $65,000 per year and has a goal of retiring at 67. And in all of these examples, we'll assume an average return per year of 10%, since that's been the stock market average over the last 50 years. Seems to make sense to me to use that as a standard. We'll also assume that they'll contribute the maximum each year, and when they get to 50, they'll also contribute the extra amount allowed. For this young 25-year-old, their current tax rate is 22%, and we'll assume that will stay the same. Finally, we'll assume they have a retirement plan with their work. So in this example, you can see that a Roth IRA beats out a traditional IRA by over $435,000, or almost 12%. In our next example, we'll go with a 40-year-old who is married, and combined they make $210,000 per year, and they also have a goal of retiring by 67. Their current tax rate is 24%, and we'll assume when they retire, they'll be in the 22% bracket. They also are part of a retirement plan at work. For this scenario, the Roth IRA ends up almost $170,000 ahead of the traditional IRA, or over 21%. And finally, let's go with a person who is 55 years old, who is also married and plans to retire at 72, and they make $150,000 per year between them. Their current tax rate is 22%, and we'll assume when they retire will also be 22%. They also are part of a retirement plan at work. For this scenario, the Roth IRA ends up almost $49,000 ahead of the traditional IRA, or almost 16%. As you can see, the Roth IRA wins out in all of these examples, and not just by a small margin. There are some instances where a traditional IRA could beat out a Roth IRA, but that would only be when someone retires and is significantly in a lower tax bracket, and the market has really poor returns over their lifetime investing. Well, that's it for this video. I hope what we covered regarding traditional and Roth IRAs can help you make an informed decision on investing your money for retirement and getting the biggest benefit out of it. As I mentioned earlier, I'll include links to the site for calculating your modified adjusted gross income and RMDs, as well as the calculator I use to show the difference between traditional and Roth IRA. As always, thanks for watching and hanging around till the end. Don't forget to like the video and subscribe so you know when I put out new content focused on your money and how to manage it best, with a little bit of comedy thrown in for good measure. See you next time.